A $1,000 investment in Berkshire Hathaway back in 1965 would be worth over $30 million today. That incredible growth stems from the vision of Warren Buffett, a man who started his journey delivering newspapers and went on to redefine investing. Now, as Buffett prepares to step away, his retirement marks the end of an era. What does this mean for the strategies that built such immense wealth? And how might his departure ripple through the financial world? Understanding his legacy could be the key to navigating what's next for your portfolio and the future of investing as a whole. Imagine a world where Warren Buffett, the Oracle of Omaha, is no longer steering Berkshire Hathaway or shaping the investment world. That scenario isn't hypothetical anymore. Buffett's decision to retire marks the end of an era, leaving a void in a market that has trusted his steady hand for decades. But what does this mean for investors and, more importantly, for the global economy? Buffett's departure signals a turning point for Berkshire Hathaway, whose identity and operations have been deeply tied to his leadership. Investors now face questions about whether the company can maintain its success without its iconic leader. Buffett didn't just manage a portfolio, he shaped how people think about value investing and long-term wealth creation. His exit introduces uncertainty for a market that has relied on his steadying influence during financial storms. As the dust settles on Buffett's departure, the market braces for change. Buffett has long been a symbol of stability, much like a lighthouse guiding ships through turbulent waters. His presence reassured investors during uncertain times, and his absence raises concerns about shaken confidence, not just in Berkshire Hathaway, but across sectors influenced by his philosophy. Without his voice advocating for rationality and long-term thinking, the market faces the challenge of navigating future downturns without his calming presence. So, Buffett's caution in recent years really underscores his view of the current market environment. Berkshire Hathaway's record cash reserves, which actually exceeded $147 billion in late 2023, reflect a very deliberate strategy. Buffett has often said he buys only when he sees bargains, and his reluctance to invest heavily right now signals his belief that, well, opportunities are pretty scarce. This approach actually mirrors his actions during past market downturns like the 2008 financial crisis, when his patience allowed him to capitalize on undervalued assets. Now, his preference for liquidity serves as both a hedge against uncertainty and, honestly, a message about the risks he perceives in today's economy. Beyond Berkshire's cash strategy, Buffett has voiced concerns about broader economic vulnerabilities, including things like rising fiscal debt and geopolitical tensions. While measured in tone, he has consistently warned of the long-term dangers posed by excessive borrowing and shifting fiscal policies. Coupled with global trade challenges such as tariffs and competition, these issues really highlight the precarious environment he leaves behind. Investors are left, wondering who, if anyone, can fill the void and command the same level of trust. Berkshire Hathaway must now navigate these waters without Buffett's guidance. Greg Abel, his designated successor, is competent and trusted, but he just doesn't have the decades of credibility Buffett brought to the table. Investors may reassess Berkshire's intrinsic value, questioning whether it can truly thrive in a post-Buffett world. The company's abundant cash holdings, once a symbol of opportunity, might now be seen as a sign of caution, leaving its future direction, well, pretty uncertain. Buffett's final moves offer insight into his enduring principles. His surprising investments in Japanese trading houses really reflect his ability to find value where others might overlook it. At the same time, his preference for liquidity over risk-taking just underscores his pragmatic approach to today's volatile market. These decisions, serve as parting strategies and a guide for navigating uncertainty. Buffett's retirement marks the start of a new era, but his principles remain a kind of roadmap for those willing to follow them. His emphasis on patience, value, and simplicity is as relevant now as ever. While his absence definitely challenges investors, it also reinforces the importance of his lessons. Legends may leave, but their wisdom endures, guiding those ready to embrace it. How did Warren Buffett transform a struggling textile company into a $1 trillion empire? The answer lies in his straightforward yet highly effective investment playbook, one built on value, patience, and discipline. These principles have guided Buffett through decades of market cycles, making his strategies a gold standard in the investing world. At the core of Buffett's philosophy is value investing, a principle he adopted from his mentor Benjamin Graham. This approach, it really focuses on finding companies whose stock prices are low relative to their intrinsic worth. Buffett analyzes fundamentals like steady earnings, minimal debt, and what he calls economic moats, those durable competitive advantages that fend off competitors. His famous advice, never invest in a business you don't understand, really underscores his emphasis on thorough research and committing only to opportunities he fully grasps. Consider Coca-Cola, one of Buffett's most iconic investments. Back in 1988, he acquired a 9.3% stake, drawn to its timeless product, irreplaceable brand, and consistent earnings potential. 35 years later, Berkshire Hathaway's stake is worth around $28 billion. This investment highlights Buffett's patience and discipline, traits that, honestly, helped him weather market volatility and achieve extraordinary results. From the fizzy success of Coca-Cola to the sweet returns of See's candies, Buffett's patience consistently reaps rewards. Take See's candies, for example. In 1972, Buffett purchased the regional candy company for $25 million, recognizing its brand power and pricing flexibility as key moat features. Over the years, See's has generated over $1.6 billion for Berkshire Hathaway. This acquisition, I think, really exemplifies Buffett's belief in buying great businesses at fair prices, a lesson he credits to his longtime partner Charlie Munger. It's a case study in how identifying a strong business model can lead to outsized results. Buffett's discipline was also evident during the dot-com bubble. While others rushed to buy tech stocks with no earnings, Buffett stayed on the sidelines, sticking to industries he understood, like insurance and consumer products. Critics called him outdated, but when the bubble burst, Berkshire Hathaway emerged unscathed. This decision really reinforced the importance of staying within your circle of competence and, just avoiding speculation. Yet Buffett's playbook isn't rigid. His 2016 investment in Apple marked a shift. Initially cautious about tech stocks, Buffett saw Apple as more than a tech company. It was a consumer product powerhouse with a loyal customer base. His $35 billion investment grew to $173 billion by 2023, proving that even the most disciplined investors can adapt without abandoning their core principles. Buffett's philosophy of patience and simplicity remains timeless. His early investment in BYD, a Chinese automaker, is another example. A $232 million stake in 2008 grew to $7.7 billion by 2021, showing how value investing applies globally. Whether it's Coca-Cola, See's, or BYD, Buffett's strategies offer a roadmap for building wealth over decades, not just weeks. What can we learn from Warren Buffett's final moves as CEO? In typical Buffett fashion, his decisions are deliberate, methodical, and packed with meaning for investors. His recent actions, from record-high cash reserves to surprising international investments, offer valuable lessons for navigating today's uncertain financial landscape. Have you ever wondered why holding cash can be a strength in turbulent times? As of early 2025, Berkshire Hathaway held an unprecedented $347.7 billion in cash. Buffett has long emphasized the importance of staying prepared for opportunities, famously saying, "We have made a lot of money by not being fully invested at all times." This massive cash reserve reflects his deep belief in patience and caution, especially in overheated or unpredictable markets. Buffett's approach reminds us that you don't need to stay fully invested at all times to build wealth. Instead, maintaining liquidity allows you to act decisively when the right opportunities arise. Buffett's cautious stance also stems from his concerns about fiscal policy and broader economic trends. He has repeatedly warned about excessive government debt, rising interest rates, and geopolitical tensions. These risks reinforce his preference for holding cash rather than rushing into overpriced assets. His strategy highlights a critical takeaway: prudence often outweighs ambition when markets seem uncertain. But Buffett hasn't been idle. One of his most unexpected moves has been his expanded interest overseas, particularly in Japan. Known for investing close to home, Buffett surprised many by betting big on 5 major Japanese trading firms back in 2019. Over the years, he increased those stakes, citing their low valuations, shareholder-friendly practices, and disciplined capital usage. These investments really exemplify Buffett's hallmark strategy of seeking undervalued businesses with strong fundamentals. The Japanese trading firms caught Buffett's attention due to their diversified operations in commodities, shipping, and energy, industries that provide reliable cash flow and growth potential. This move also reflects his willingness to venture beyond familiar territory while maintaining his disciplined approach. For investors, it's a reminder that strong opportunities can appear anywhere, but only if you're patient and willing to look. Buffett's focus on undervalued markets ties back to his broader philosophy of staying calm during uncertainty. Many investors shy away from international markets like Japan, seeing them as risky or maybe just too unfamiliar. But honestly, Buffett's decisions really highlight the value of focusing on fundamentals rather than letting fear take over. His timeless rule, time in the market beats timing the market, is still as relevant as ever. So, key takeaways from Buffett's final moves include: first, liquidity management, always maintain the flexibility to act on opportunities. Next, international diversification. Don't be afraid to look beyond familiar markets for undervalued assets. And of course, long-term thinking. Stick to strong principles, even when times are volatile. Buffett's actions remind us that simplicity, patience, and strategy are just timeless tools for navigating uncertainty. As he transitions into retirement, his legacy really does offer a clear path forward for generations of investors. Warren Buffett's retirement marks the close of a legendary career, but his investment principles remain a timeless guide for navigating today's unpredictable markets. His decisions, like holding $347.7 billion in cash and investing in undervalued Japanese companies, really underscore the value of patience, preparation, and sticking to fundamentals. Even without Buffett at the helm, his strategies provide a clear roadmap for building long-term wealth. So how will you turn uncertainty into opportunity? Chart your own course using Buffett's map and go ahead, share your insights below. And don't forget to check out our other financial literacy and education videos.